So, how did Goldman Sachs determine the intrinsic value of Twitter? Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Twitter is that Goldman Sachs evaluated Elon Musk's offer as fair. Interesting. This is Andrew Stotz of the Valuation Masterclass. Let's get started. This information is for learning purposes only. This is not investment advice or recommendation. So here is a Schedule 14A, which is a proxy statement pursuant to Section 14A of the SEC Act. And it's filed by Twitter in this case. And basically, it's trying to show the details about the transaction with Elon Musk. So Elon Musk is going to give a bid or an offer to buy Twitter. And the Twitter board has to take that and get it evaluated and think about what is Twitter worth. Imagine if Elon Musk said, I'll pay $10 per share for Twitter. Well, clearly that's not worth it for the shareholders because the share price in the stock market is much higher than that. So, but they need to get some advice and evaluation on the Twitter side so that the shareholders, as well as the board, can make the right decision. And that's what's in this filing. So let's go into the filing and learn more about it. First, what we can see is opinion of Goldman Sachs and Company, LLC. At a meeting of the Twitter board held on April 25th, 2022, Goldman Sachs rendered its oral opinion. And it followed that with a written opinion that they said the company's worth $54.20 in cash per share to be paid to the holders of such shares pursuant to the merger agreement. They felt that this was fair from a financial point of view to such holders, to meaning the shareholders. Now, they are saying other than parent Mr. Musk and their respective affiliates, because Goldman Sachs is not advising Musk in this case, they're advising the board. And so let's understand. So the full text of the written opinion of Goldman Sachs dated 25th, which sets forth the assumptions made, procedures followed, and matters considered and limitations of the review undertaken, is attached in the appendix. So Goldman Sachs provided advisory services and its opinion for information and assistance of the Twitter board in connection with this transaction. So Elon Musk's offer price was 67% above 52-week low, but 24% below its 52-week high. So this is the first thing that was disclosed by Twitter, is what was the range of the offer at 54.2 offer. So Goldman Sachs used different methods to calculate the fair value. There's 4 of them. Let's look at the illustrative future value, the discounted cash flow, the precedent transactions, and the selected comparables. So first is the illustrative future value of the shares, and step 1 is to forecast the future implied enterprise value through the EBITDA multiple. So they're saying, what is this company worth using multiples? And first, they calculated the implied future enterprise value of Twitter as of December 31st, 2022, so the end of this year, the end of next year, and the end of the year after, by applying a range of enterprise values to 1-year forward EBITDA estimates. Multiples of 15 to 17.5 times was the multiples that they used based upon the price and based upon the earnings, or EBITDA, earnings before interest, depreciation, taxes, depreciation, and amortization. So here we can see what they're saying it would be worth, 15 to 17.5 times EBITDA, or EV to EBITDA. Now they had to add cash and equity investments to the enterprise value and then subtract debt to derive the final equity value, because remember, EV to EBITDA is valuing the whole company, both debt and equity for the providers of capital. So they have to eventually subtract that debt to get to the equity level. Goldman Sachs then added the amount of Twitter's estimated cash and cash equivalents and equity investments and subtracted the amount of Twitter's estimated total debt at those different periods of time. So they calculated the value of the overall company, and then they added back cash that the company has, because when you're looking at an EV to EBITDA multiple, you're looking at the operations of the business. The cash is a secondary item. So they added back the cash, and then they also subtracted out the debt. And Goldman Sachs then divided these implied equity values by the projected number of shares outstanding. So they were able to use those multiples over time and then come up with value. And then they bring it down to a per share level. Now, the next thing they need to do is they've now got the value of the equity, because they valued the whole company, then they subtracted the debt. Now they have the value of the equity. So what they now need to do is discount that. So they use the CAPM, capital asset pricing model, to derive equity costs and discount estimated equity value to today's value. So what do they say in their disclosure? Goldman Sachs then discounted these implied equity values per share back to December 21st or 31st, 2021, using an illustrative discount rate of 11.4. What does it mean, illustrative discount rate? Well, I just call it a discount rate. So they use 11% discount rate, which to me is a bit low, but it's reflecting an estimate of Twitter's cost of equity. Goldman Sachs derives such discount rate by application of the capital asset pricing model. And basically, that means you got to look at the company's beta, you got to look at the risk-free rate of the overall US market and the equity risk premium. Now, we have been through a very low interest rate environment, so it's possible that they forecasted very low risk-free rate. And also, we've been through a boom in the stock market, and I suspect that's going to come down. Both of those factors tell me that the discount rate probably could be a little bit higher than this 11.4 in reality if I was looking at it. So now what they got was a range. Here we can see at the bottom, a range of 45.5 to 60.1, depending on what year of EV to EBITDA that they got, right? What level of enterprise value they got at each year. They discounted each one of those back separately. So if you value a company by EV to EBITDA or any multiple, PE or any multiple, normally we just go 1 year ahead and say, okay, by the end of this year, let's look at the full year financials and say, what is the earnings per share that this company is going to have at that period? But the problem is sometimes when a company's losing money and not doing well, you go out further hoping that they're making money, and then you may come up with a higher value. Let's say you go 5 years out and you use a multiple 5 years out. Now you have to discount that amount that you get, that value you get at 5 years out. You've got to discount that by a discount rate. Now, some of you have asked some questions, so let's just look at some of the questions here. So the first question that I see is from Papa Benny. You said the discount rate is quite low. What do you think qualifies as the normal discount rate? Well, I would say that, you could argue that a range of discount rates in the US is somewhere between 8 and 13%. That's kind of my range that I look at. If you go outside of 13, you go higher, it's definitely a higher risk company. If you go below 8, you got to be really careful because you could be overestimating the value of that company. So if they say 11.4 in this case, I probably would say about 13% probably is what it could be. Next question comes from P. Out of many multiples, why Twitter is suitable for EV to EBITDA? That's a great question. And why is it a great question? Because don't we normally just use PE? Well, the price earnings ratio is not always used in takeover situations and offering situations like this. And so people like to use the EV to EBITDA. It's a more robust, it's less volatile. But keep in mind that if Twitter's losing money at any time, you can't use the PE ratio because it's a negative E. So that's where EV to EBITDA helps you value many companies as long as they're positive at the EBITDA level. Okay, next question comes from Natik. Says, why is the discount rate of 11.4 low? Well, number one, I bet you that their level of their level of risk-free rate is probably pretty low. We've just been through a period where interest rates were close to zero for a long, long time. And I suspect that they picked pretty low interest rate. Whereas now, as everybody expects that the interest rates are going to be rising and the Fed's going to be increasing, that the discount rate you may use today would be higher only because the risk-free rate that you're going to assume would be higher. Now, the other one is the equity risk premium. And I would say that basically it's been good times in the stock market, but those good times aren't going to last forever. So I would just say the last thing is that for my students in the valuation masterclass, I always talk about pizza when I talk about capital asset pricing model. It doesn't matter so much how you slice it. What matters is what your level is. And I would say I would go with something closer to 13%. All right, so let's continue on. If you have any questions, make sure to ask them. Let's continue on. So now let's look at the discounted cash flow analysis. So they forecasted free cash flows and determined an exit multiple for the terminal value. So the discount rates range from 10 to 12%, and that is representing the company's weighted average cost of capital. And because it's the first one was 11% and this is 10 to 12, because they're so close, you can see that Twitter doesn't have a lot of debt. So the weighted average cost of capital is very, very close to the cost of equity that we saw earlier of 11%. So now this cost, weighted average cost of capital is basically, could be a little bit high because over time they could borrow more money and money is relatively cheap right now. So I would say that this number that ranges between 10 and 12% could be a little bit high. Now, that's because a lot of times when people forecast companies, they look at the amount of debt or cash that a company has today and they forecast that going to the future. But I always teach in the valuation masterclass that even if a company only has 5% debt in their total capital structure, I still may show them in the fade and in the terminal period that they're going to have 10, 15, 20% debt just because I know that things change. So that cost of capital, I would say, is a little bit high. So here we can see point number 2. It says a range of illustrative terminal values for Twitter, which were calculated by applying illustrative exit terminal multiples ranging from 10 to 15 times to a terminal year estimate of EBITDA as reflected in forecasts, which implies perpetuity growth rates between 5.6 and 9. Now, this also shows you that these very high, relatively high multiples for the terminal period, meaning you're trying to value the company's cash flows after the next 3 years and say, what is it worth going forward? Now, I generally use a maximum of about 5% for the terminal growth rate. So to see 5.6 to 9%, that is a pretty high terminal growth rate. So I would say that that is probably overestimating the value. Now, they add cash and equity investments to the enterprise value, and then they subtract debt. Goldman Sachs derived a range of illustrative enterprise values for Twitter by adding the ranges of present values it derived. And then they added to the range of illustrative enterprise values it derived for Twitter the amount of Twitter's estimated cash. So we just add cash on because remember, when you're doing a free cash flow analysis, you're valuing the operating business, not the cash. So you can add the cash back. And you can add equity investments because equity investments are not part of the operations. And then you subtract the debt. And the range that they come up with is 39.1 to 60.9. So we got 39 to 61 as a discounted cash flow value estimate. Now, before I show you my valuation of Twitter, if you want to learn how to value companies like this, check out my 6-week online valuation masterclass bootcamp. Today is what? Today is the 18th, and the bootcamp starts on the 23rd. So we're going to be launching the next bootcamp 23rd. For those people that are watching this after the 23rd, we do have more boot camps opening over time. In the boot camp, you learn practical stock valuation skills. You get access to the tools, tips, and tricks that I use, and you'll join a group of inspiring, like-minded professionals, and you'll get a job or a better job, hopefully, through my network of thousands of finance industry leaders. Join for just $797 until May 19th. You just scan this QR code or go to valuationmasterclass.com/bootcamp. All right, let's look at the third method, precedent analysis. So step one was they had to identify similar past transactions. Here is their list of similar past transactions. And from it, you can see that these EV to EBITDA multiples are very huge, ranging from as high as 50 times for Liberty Interactive Corp when they bought Zulily, and down to a low of 21.5 when Silver Lake bought ZPG PLC. So we can see that the EV to EBITDA multiples are pretty extended. Now, also, this is before, you can see that these transactions happened from 2011 all the way up to 2021, but they haven't been into 2022, where multiples may have come down. Now, I'm just going to take a second and try to answer a question. So here we go. The question is from Tampiorubari. What factors should we consider when choosing the terminal growth rate? Well, I think the most important factor is that you have to think that the terminal growth rate is to infinity. And when I look at, basically what I do is I look at the growth rate in nominal GDP over the last 50 years or so. And the nominal GDP growth rate for the world and for the US was, let's just say, about 6%. So then the next question you have to think about is, what is growth rate going to be over the next 20, 30 years? Is it going to be the same as the past? I would say that we've been through a boom time, and so I'm going to expect that it slows down to about 5%. So that's my assumption for nominal GDP for the overall economy. Then the next question is, how much can this company grow its terminal growth rate relative to the overall economy? Now, what Goldman Sachs doesn't mention is a fade period. We have a fade period in all our valuations so that we value it during a discrete period where we have the data, and then we fade that down, and then we get to the terminal value. So it gets a little bit more complicated. We'd have to look at what's their fade period to understand this. But the last thing I would say is that if you have the economy growing at, let's say, 5% to infinity, and you have any company growing at 6%, even if the company's small, eventually that company will become larger than the economy. And if that's the case, it doesn't make sense because that company is part of the economy, so it can't grow to be bigger than the economy. And as a result, the upper bound of the terminal growth rate tends to be about 5 or 6% in my world. Now, Goldman Sachs has a very high terminal growth rate there, and I think that can, particularly when a company is not making a lot of money today, but they're expected to make a lot of money in the future. If you choose a very high growth rate of that terminal value, the terminal period cash flow, then you could really, really cause the value to increase. So that's a little bit of discussion there. Let's continue on. So you're going to apply an EV to EBITDA multiple to Twitter. The foregoing analysis indicated a 25% EV to EBITDA multiple, and they're saying long-term LTM, I'm thinking that's long-term, but multiple of 28.2 and a 75% percentile of 35.7. Wow, that is a big range and a very high level. And that level of multiple at the bottom provides a valuation of 50.3 to 62.9. So there we have the illustrated future value 46 to 60, the discounted cash flow value from 39 to 61, and the precedent transactions from 50 to 63. The last one is selected comparables. Now remember, if you have questions, ask them in the chat, ask them below, and I'll do my best to try to answer them. So how do you do comparables? Well, you're going to look for the closest peers. And here, what we can see is that the closest peers are Alphabet, Meta, Pinterest, Snap. So those 4 peers are the most comparable. And I'm just going to draw a line here. Hold on, let me just grab my pen. So I'm just going to draw a line here, and we can say that those are the comparables. And what you can see is Snap is crazy, crazy high. Why? Usually because EV is the value of the company and EBITDA is a measure of profit. I suspect, although I haven't looked at Snap recently, I suspect that Snap has a very low level of profit. And if it has a very low level of profit, particularly for 1 or 2 years, what you'll see is that the EV to EBITDA ratio will shoot up. And in this case, it shot up to 62. So I would say that this is not really a usable number at 62.8. What's more usable is Alphabet Meta. I think that these two are interesting because, first of all, they're very successful companies and they're making huge return on equity and return on invested capital. Twitter is not making huge returns. In fact, they have a very weak level of profitability. So if a very profitable company like Alphabet is trading on a 12 times EV to EBITDA, then how is it that you're going to buy Twitter at such a high multiple? So here, that based on the forecast and based upon IBES estimate, which is consensus estimate, they're coming up with, let's say, about 20 to 22 times as a fair level of multiple relative to peers. So here we can see that it's actually relatively expensive. So do you want to know how I valued Twitter? Well, check out my previous video where I open my value model of Twitter. In fact, I'll also put a link in this presentation. But scan this QR code to learn more. Or just go to the YouTube and subscribe to the Valuation Masterclass. And there you have it, my estimate of value of Twitter. So here we can see that an advisor, even an advisor as is distinguished as Goldman Sachs, you can question those assumptions. So if there's any questions, let's go through it. Here I can see a question has come in from Lingon. It says, if you own Twitter, would you accept Elon Musk's offer? Absolutely. I would accept it like that. And I would accept it like that because basically, I don't think you're going to get anything better. And right now, Twitter is just in a difficult situation. And from my perspective as a legacy shareholder, that it's only going to go so far. You're not going to be able to get it above that level. In fact, 50, we can already see that 50, a value of 50 is already a pretty optimistic value. And remember, the shareholders are not getting the chance to ride along with Elon Musk. They either don't sell to him or they sell all shares to him. That's the deal. And so you really don't have a choice. And I would say, from my experience, I would sell to Elon Musk. Jordan, great to see you. And so that gives you a picture of what's happening with how Elon Musk and Goldman Sachs, as well as how, in this case, Twitter was able to understand what value they're worth and whether or not they should take the offer from Elon Musk. And the answer is, if it was at the original price, then I would take that. Of course, lots of things have happened recently, and that may drive down the price further. But for right now, I would accept Elon Musk's